Jim Simons is a math genius, a hedge fund pioneer, and one of the most successful investors of all time. He is the founder of Renaissance Technologies, a quantitative hedge fund that has generated massive returns for its investors over the years. Simons is known for his revolutionary approach to investing, which is based on complex mathematical algorithms and statistical models. His net worth is estimated to be around $23 billion, making him one of the wealthiest people in the world. Despite his enormous success, Simons remains humble and dedicated to his work, using his wealth to support philanthropic causes and advance scientific research. His life and accomplishments are a testament to the power of hard work, innovation, and a lifelong commitment to learning. I wasn't the fastest guy in the world. I wouldn't have done well in an Olympiad or a math contest, but I like to ponder, and pondering things, just sort of thinking about it and thinking about it, turns out to be a pretty good approach. Of course, we can't show the model or tell people how we calculate our forecasts. That would be like Warren Buffett telling the world what stocks he's buying before he buys them. One can predict the course of a comet more easily than one can predict the course of Citigroup stock. The attractiveness, of course, is that you can make more money successfully predicting a stock than you can a comet. Patterns of price movement are not random. However, they're close enough to random. We have 3 criteria: if it's publicly traded, liquid, and amenable to modeling, we trade it. Past performance is the best predictor of success. Luck plays a meaningful role in everyone's lives. We don't want to give away our big secrets here. The system is always leaking, and we keep having to add water to keep it ahead of the game. If gold is discovered, then it gets harder to make money mining gold because everyone's competing with you. Patterns of price movement are not random. However, they're close enough to random so that getting some excess, some edge out of it, is not easy and not so obvious, thank God. God probably doesn't care, thank whoever. Size works against you in a fund like this. There's no such thing as the goose that lays the golden egg forever. In this business, it's easy to confuse luck with brains. Efficient market theory is correct in that there are no gross inefficiencies, but we look at anomalies that may be small in size and brief in time. We make our forecast. Then, shortly thereafter, we reevaluate the situation and revise our forecast and our portfolio. We do this all day long. We're always in and out and out and in, so we're dependent on activity to make money. The things we are doing will not go away. We may have bad years, we may have a terrible year sometimes, but the principles we've discovered are valid. We don't override the models. We search through historical data looking for anomalous patterns that we would not expect to occur at random. Once we find one, we test it for statistical significance and consistency over time. After we determine its validity, we ask, does this correspond to some aspect of behavior that seems reasonable? Once in a while, the phenomena we exploit are particularly present. We like a reasonable amount of volatility. In our business, we want some action. We have very high standards and it works. Our business is wonderful as a result. It's difficult to run a business and be so consumed with another passion. While we believe we have an excellent set of predictive signals, some of these are undoubtedly shared by a number of long, short hedge funds. We manage funds whose trading is determined by mathematical formulas. We operate only in highly liquid publicly traded securities, meaning we don't trade in credit default swaps or collateralized debt obligations. Our trading models actually tend to be contrarian, often buying stocks recently out of favor and selling those recently in favor. Some firms say they have models. What they typically mean is the model advises the trader what to do, and if he likes the advice, he'll take it, and if he doesn't like the advice, he won't take it. I've got to figure out, at least probabilistically, what's coming next. It's kind of like code cracking. It's a little bit more vague. At least with code cracking, you know there's a machine that's doing this and has some structure to it. Here, it's the human race that's making these things happen. We decided that systematic trading was best. Fundamental trading gave me ulcers. One day you'd come in and you'd think you're a genius and the market's away, and the next day down and you'd think you're an idiot. Even if you're a genius one day more than you're an idiot, it's still a very stressful way to make a living. We're right 50.75% of the time, but we're 100% right 50.75% of the time, Mercer told a friend. You can make billions that way. The strategies were often based on the idea that prices tend to revert after an initial move higher or lower. For all the unique data, computer firepower, special talent, and trading and risk management expertise Renaissance has gathered, the firm only profits on barely more than 50% of its trades, a sign of how challenging it is to try to beat the market and how foolish it is for most investors to try. Scrutinize historic price information to discover sequences that might repeat, under the assumption that investors will exhibit similar behavior in the future. Humans are prone to fear, greed, and outright panic, all of which tend to sow volatility in financial markets. Machines could make markets more stable if they elbow out individuals governed by biases and emotions. Detach from human emotion. Never place too much trust in trading models. Buying and selling infrequently magnifies the consequences of each move. Mess up a couple times, and your portfolio could be doomed. Make a lot of trades, however, and each individual move is less important, reducing a portfolio's overall risk. God gave me a tail to keep off the flies, but I'd rather have had no tail and no flies.